Mortgage rates have been rising since the beginning of 2022, all thanks to the Federal Reserve's decision to raise interest rates in order to combat inflation. But mortgage rates fell after a recent Consumer Price Index report showed lower than expected inflation, despite the fact that the Fed recently raised rates for the sixth time. The rising rate trend, which we all know mortgage rates began the year at historically low levels. The average 30-year mortgage rate was 3.22%, and the 15-year mortgage rate was 2.43%. However, the Federal Reserve raised interest rates by 25 basis points in March, and by the end of the month, the average 30-year mortgage rate was 4.67%, and the average 15-year mortgage rate was 3.83%. With this in mind, mortgage rates rose as the Fed continued to raise interest rates. From here on, they appear to have peaked in late June, with the 30-year yield at 5.81% and 15-year yield at 4.92%. But when inflation data came in lower than expected over the summer, many believed that inflation was finally cooling and that the Fed would slow its rate hikes. However, things quickly changed when more inflation data showed that the inflation was not slowing. This resulted in additional Fed rate hikes and a steady rise in interest rates to where we are today. So why did rates drop? Well, the federal funds rate, which is the interest rate that the banks charge each other for lending money, has an effect on mortgage rates. In short, bank borrowing costs rise when the Fed raises interest rates. To compensate for the rate increase in cost, they raise the interest rate on their loan products. However, the Fed funds rate is only one of many factors influencing mortgage rates. The bond market also plays a huge factor. The majority of banks do not hold the mortgages they underwrite. They package them into a product known as MortgageBacked Security and sells those to potential investors. Now, because bond buyers want a competitive return on their investment, the interest rate on mortgage-backed securities must be high enough to attract buyers. The question is, how high? The 10-year Treasury bond yield is the most common benchmark used by lenders to set mortgage rates. As a result, the interest rates on mortgage-backed securities must be higher than the 10-year Treasury yield, because mortgage-backed securities carry more risk than Treasury bonds. Another major element is the housing market. If home prices are so high that buyers choose to rent rather than buy, lower demand affects interest rates as a result. This is because if very few people are buying homes, interest rates must fall to encourage buyers to enter the market. The same is true on the other side. If a large number of consumers want to buy, mortgage rates may rise. The supply of housing also has an effect. If there is an insufficient supply, rates may rise if demand is high. Finally, unemployment comes into play. People who have lost their jobs are unlikely to buy a house. Fear of losing one's job is also another concern. With the recession just around the corner, people will likely not make a large purchase like a home if they believe they will be out of work soon. All of these factors work together to determine where mortgage rates are. Mortgage rates are determined by multiple sources. In summary, banks weigh all of the above information before deciding on a competitive rate. Because each bank sets its own rate, experts advise home buyers to shop around. While one bank may charge 7%, another may charge 6.5%. It all depends on the factors, as well as your credit profile. This is not to say that in today's market, you can expect to find a bank offering 3%. The rates you are quoted will fall within a narrow range. This should not deter you from looking for the best deal. A low interest rate will not only reduce your monthly payment, but it will also save you thousands of dollars in interest over the life of your loan. Consumers can anticipate lower mortgage rates, but until then, it's sensible to lock in rates now, as future inflation reports may cause rates to rise. If interest rates begin to fall, you could refinance to take advantage of the lower rates. Of course, it's important for you to keep track of what's going on in real estate, and if you're doing so because you want to buy a house, it's critical to keep your investments liquid so you can consider that all too daunting down payment when the time comes. Alright guys, thanks for watching my videos. Please give me a thumbs up, subscribe, and if you have any comments, just leave a comment down below.